Okay, so today's cardinal lesson is estate planning at age 65 using life insurance. And we use a lot of annuities, we use a lot of investments, we use long-term care insurance, we use Medicare insurance, we use life insurance. And so there's a lot of insurance in our financial planning. That doesn't mean everybody buys life insurance, everybody buys annuities, everybody buys Medicare. But we have all these tools that we use when we create a financial plan for somebody. And today we're talking about life insurance. And immediately people can think, gee, I don't need any life insurance at 65. My kids are grown, my house is paid for, I got my retirement income coming in, and I'm going to tend to agree with that. Certainly if you don't need life insurance, maybe you need less, but we're not really characterizing life insurance today as from a pure need, like he's gone, we need the stuff for income. We're using it for estate planning. Now, I want to bring Tom on of why we're doing this video. I want Tom to talk to why we're doing this video today.
Yeah, I mean, we're doing this video because a lot of people come in, and we talk a lot in our channel and our YouTube videos about Roth IRAs and how they're tax free, all the benefits there, and people get so sold on this idea that they forget there are other tools that are also tax free. Life insurance being a big one, right? The death benefit on life insurance comes to the beneficiaries tax free. I mean, that's just very clear. It's been in the tax code. Essentially, income taxes existed essentially. And so it's a very nice thing to be able to give your heirs tax-free money, and life insurance is another tool that can be used to do that. There's some differences between Roth and life insurance, and we'll get into that as we go through the video. But we just wanted to introduce this idea as something that's built as part of a larger financial plan, as part of a larger estate planning vehicle to help pass on money to the next generation. So let me bring up the show notes. We have these at the link below our video. They're also on our website. We have the board. As always, we also have the illustration for the life insurance policy that we're going to describe. We'll spend most of the time on the board, but if you want to get in there and look at more of the specifics, we have the actual illustration pulled out here. One of the things, I'll just scroll down a little bit. Any of the numbers on the board we have highlighted here. So this is really the chart that shows the premiums over time. It shows the cash value, the death benefit. It goes into all those different things. So if you want more details, they're here in the show notes, but we'll turn it back to Hans. We'll get into sort of simplifying what's in this long document into something that's easily to understand on the board here.
Okay, so when we're doing financial planning, as we've said before, we're looking at your Social Security, we're looking at the fact that you might use long-term care, and we're going to need to have a pot of money to draw on for that. We're looking at your IRA, 401k money, and we're trying to get some of that tax-free with a Roth. We're trying to create an income from that, make sure it doesn't run out when you're drawing money out. We're going to use annuities as tools to create an income, and we're looking at what's left when either one of you or both of you pass away to go on to the survivors and how important that is to you. We're looking at the tax implications, and then we're looking at taxes. So we put together this comprehensive plan, and that kind of comes at the end. And so today we're talking about using the tool of life insurance to do several things. And the first thing that life insurance does is it creates an immediate estate, in this example for this 65-year-old person, of $250,000. So this is the amount, no matter when you die, if you're this person or this is your spouse, that is going to go to the beneficiaries. So this thing works great for somebody that has a specific bequest in mind. And we get a lot of single people that buy this stuff, and they buy something like this, and they want to leave to one of their nieces or nephews or somebody really important to them, and they don't want it in their estate. They don't want it mucked around in that. You can do this and name them the beneficiary, and nobody's ever going to know. So that's the first thing it does, is it's going to pay off $250,000 tax-free to the beneficiaries at your death. Now, and that is not necessarily the primary reason that we're putting it in there. We're creating an account which has a cash value build up. You're paid interest on that account, and then you're going to have access to that account later on a tax-free basis, okay, providing you do it all correctly. And so it's, as Tom said earlier, this is an alternative account. Now, in the example that we've shown, we have this person paying premiums over 5 years. So they're going to be paying a total of $134,000 over 5 years. And the cash value at the end of that 5th year is going to be projected to be $140,000. So not a lot of interest growth during the first 5 years while you're accumulating the money, but it gets better after that. And the life insurance costs are buried into all that. So when you're looking at this growth in the early years, just remember that this is net of the cost of life insurance. So why would you want to do this? Is first of all, the government was clear back in 1986. Before then, I was actually in the insurance business then, in the investment business, is you used to be able to load up a life insurance policy in the first year. So you could stick $100,000 into a $250,000 policy just in a lump. And you would enjoy all these benefits I'm talking about today. And the government wanted to stop that, the IRS. And so they just said that this is, you got tax-free accumulation, essentially, and you can borrow the money back out and you can do all these things. They wanted to stop it, but they didn't want to stop life insurance. So they created this thing called the Modified Endowment Contract, MEC. And I don't want to get into an explanation of that, but it basically makes you spread out the premium over the first few years. So you can't put in a lump, but you can stay right under a threshold. And in the example I've created, you're going to pay premium over 5 years, $27,000 plus a year. And then in the 5th year, it's a little bit less than that, okay? This is the maximum amount of money that you can kick in a $250,000 policy with this company. You want to put in more, you simply double it. And you're going to go to a $500,000 policy and you could put in 270 some thousand. So this is just an example, and I tried to make it an example that was in numbers realistic that somebody felt like they could do. Now, where are you going to get this $27,000 a year? I mean, you could just get it out of a savings account. You could get it out of an income if your income's high enough, and then you'd say, well, why wouldn't I just transfer all the money in the savings account or the CD or something in there? Well, remember, you can't do that, because if you load it all up in the first year, you're going to lose a lot of these sweet benefits and the tax-free loans and that sort of thing. So a lot of people get this out of their IRA. So as an alternative to a Roth conversion, or maybe they don't, as an exclusion of the Roth conversion, they do some of this, some of the Roth, okay? And when you do a Roth conversion, you got to pay the taxes first. So if you were going to get this out of your IRA, you probably would have to draw out $35,000 to $40,000, depending on your tax rates. You'd pay the taxes, you'd net the $27,000, send it to the insurance company. You're going to do that every year for 5 years. And then you're going to be lowering the balance in your taxable IRA, which is going to effectively lower your required minimum distributions at 73. So it works along the same lines. If that's not enough for you, then you can double this. You could buy a $500,000 policy. You could buy $1 million policy. I mean, we've had people buy $1 million on the husband and $1 million on the wife. And I might add, I've run the rates at this at standard rates. So I've run it, and what standard is like I'm standard when I come into a life insurance company. Just look at me. I mean, I'm not your picture of health. They have better rates than this, but I don't want to illustrate it. I want to illustrate it in a more realistic way for a 65-year-old person. If this was a lady doing this, it would be less. If this was a person in great health, good height and weight, good exercise, good labs when they go for their physical, that kind of thing, and they were in the preferred rate class, you would either pay in less or you'd get more life insurance for the same money. So if you can still buy these on a rated basis, and we do that for people that have had heart and circulatory problems or problems with diabetes, As long as it's well controlled, you could buy this, but you'd have to pay a little bit more because of your illnesses. I don't want to get too much into this. I've run this at the standard rate where most of the population is going to fall into that. And the whole idea of this is to load the thing up over 5 years, and then you're done paying. And then what you're going to get with this is the choice to take these benefits. Now, I want to bring Tom on, and I want Tom to just add something to what I've done here with the introduction.
Yeah, I mean, I think one of the things that's really nice about these policies as a tool, right? I mean, there's a lot of similarities to a Roth conversion, right? As we're taking money and maybe we're funding the premiums out of distributions out of the IRA, as an example, and you have to pay taxes to do that. It gets into the life insurance, and now the death benefit's tax free. You can access the cash value in the policy tax free via a loan. Again, don't do this on your own. Talk to someone who knows how these work before you do this, but you can access the cash value via loan. It's tax free. And then what's nice about this, what's different, one of the main differences between this and a Roth IRA is you can pay that loan back. And so, you might use it. So, I mean, Hans will get into a more of an example. He used it to start this business, Cardinal, right? He has life insurance personally himself. He borrowed money out of that to start this business. And then the profits from the business, he then paid back the loan. But you could do that on business ventures. You could do it on maybe you have a lot invested in the market and you're worried about market fluctuations, right? Maybe you don't have any annuities, you don't have enough streams of income, and so you're relying on taking distributions out of your portfolio, which looks great when the markets are up. But as soon as the markets pull back, now you're sitting here worried about pulling money out, selling things at a loss to create your income. You could go to the life insurance in that example, borrow money out, use it to cover your living expenses, and then when the markets recover, pay it back. So what's nice about this compared to a Roth is you can pay the money back once you pulled it out. Whereas if you pull a distribution out of the Roth IRA, you can't put that money back in. Once it's out, it's gone. You can never put it back. And so that is a main difference between this tool, this type of vehicle versus a traditional Roth account that we do a lot of videos on.
Okay. And then on those loans, it's a little complicated to explain, but your net cost is 0% interest. That's your interest rate. And Tom is correct. I bought some very large life insurance policies on myself and my wife when we were in our early 40s, and I was doing quite well as a corporate officer of an insurance company. Over several years, I paid the premium, so it met in with that thing. And when it came time to start this business, I made a real substantial loan, pulling the cash value out in the form of a loan, paid 0% interest. And then after the business got established and was going, I paid all the money back. And that money, and I've since, when we downsized our house, I wanted to buy the new one before I dumped the old one. And I had mortgages and all kinds of stuff going in there. And I bought the new one. I just borrowed the money from the life insurance policy, bought the new house with cash. Took us about 6-7 months to sell the old house. And then after we'd moved into the new one, and when we got the money out of that, I paid back the insurance company, and now that money's paid back. And it has a tremendous amount of flexibility. And some people are going to borrow from these in their older years, and they're not going to pay it back. And then it'll just get paid back when they pass away out of the death benefit. So you can tap the money, have a zero cost loan, spend the money, use the money, and then a lot of these policies now have this overloan protection rider that prevents the policy. If you tap the cash value too much through loans, never pay it back, and then you die, it has this rider that keeps the policy and makes sure that $250,000 is there for your beneficiaries to pay off the loan and to pay them the balance at death. So it's a pretty sweet thing. Now, I want to talk also about long-term care. So this is not necessarily a great substitute for long-term care insurance, but when there's just a lot of people get stubborn about buying long-term care insurance, even buying it with a single premium stuff, but yet they'll buy this. And so then it is a good substitute because in the absence of the other, This thing at $250,000 has a $47,000 chronic illness benefit. So again, it's not long-term care insurance, but it has some similarities. And if you can't meet 2 of the 6 of activities of daily living, which is how long-term care many times is defined, you can take an early payment of your life insurance to the tune of $47,000 a year for 4 years. Or essentially, you're getting the $250,000 paid out tax-free to you to help pay for your care. And if somebody really wanted to start using this for long-term care, I'd recommend they buy $500,000 and fund it out of their IRA, pay the taxes, and then the money will be sitting there. If they get older and they need the money, they can borrow it. But if they need long-term care, I would recommend not doing that. And you can tap this thing tax-free to pay your long-term care bills. So with the net zero loans, this is an alternative to Roth conversions. So part of the alternative is you can pay it back, and it has the larger death benefit. You can use it for a supplemental income in the later years, and then ultimately it's going to be a tax-free payment to your beneficiaries. So I want to bring Tom back on. I'm Hans Scheil, and I thank you very much for listening.
And I'm Tom Griffith. Thank you.